Good morning, good evening, good afternoon, everyone. Sentiment in crypto right now is rough. Prices have been grinding. Crypto Twitter or X is relatively quiet compared to what it was. And a lot of people who were excited not that long ago have checked out or are more focused on the actual news and macro compared to posting daily charts, for example. And I get it, when nothing is really moving, it's hard to stay interested. But here's the thing, while everyone is or isn't watching the price, something else is happening. And that's where it matters the most for crypto long term. And it might seem like everything is going very slow right now, but actually things have never gone this fast. Most retail investors might not realize this, but there's a lot of things going on in the background, and I'm not just talking about things like the Clarity Act. Before I explain what I mean, don't forget to subscribe if you want to follow along. I also want to give a big shout out to Alt Crypto Gems for giving me this really cool t-shirt. A link is in the description below if you want to go check it out and get one yourself. Two worlds are converging right now, traditional finance and crypto. And I don't think neither side fully realizes they're building towards the same place, or at least the same goal, even if the story has always been DeFi versus TradFi. But that gap between the two narratives is where the future lies, and it's also the reason why sentiment feels completely disconnected from what's actually being built out there. If you spend enough time in crypto and seen some cycles, the framing is pretty clear. Decentralization should win. Banks, and in broader terms, other middleman institutions, are slow, inefficient, and eventually obsolete. The whole point is to build something that doesn't need them. Now, go sit in a room with a traditional asset manager rolling out a tokenization pilot, and the conversation sounds completely different. They're thinking about settlement efficiency, collateral mobility, and cutting the operational costs of moving money across counterparties. They're approaching blockchain the same way they approached cloud infrastructure a decade ago, which was more quiet, practical, and without any interest in what retail crypto market thinks about it. Two completely separate motivations and two completely separate conversations, and yet they're converging on the same technical layer with the same infrastructure. Web3 retail thinks it's fighting a war against the banks, and institutions think they're simply replacing legacy infrastructure with something more efficient. And I think both are wrong about what's actually happening. I don't think what I'm saying here is a theory. The evidence showed up in February of this year within about a week of each other, and it's important to connect those two. First, you have BlackRock, who listed its tokenized US Treasury fund, which is called BUIDL, on Uniswap, the world's largest asset manager, putting a regulated yield-bearing product directly on the DeFi exchange. They also bought Uniswap's government token, putting a DeFi native asset on their own balance sheets for the very first time. This is a directional bet and a pretty loud one for a company that doesn't really make a lot of noise. You could argue with me on that, but the second example, almost at the same time, Apollo, with roughly almost $1 billion in assets, agreed to acquire up to 9% of Morpho's government's token supply over 4 years. The mandate is to co-develop on-chain lending markets and participate directly in the protocol governments. Two of the largest asset managers in the world, both choosing to build on the same on-chain lending and trading layer that crypto-native protocols spent years developing. Now that's a meaningful line to cross. The reason sentiment feels so detached from these fundamentals is that the market is still pricing crypto mainly as a speculative asset class. Price goes up when people are excited. Price goes down when, of course, they're not. Macro noise, political headlines, leverage cycles, all of that hits retail sentiments very hard and very fast. But a growing chunk of what's being built right now operates completely independently of retail mood. A tokenized treasury fund settling on Uniswap doesn't really care about the sentiment on X. Apollo's government's participation in Morpho doesn't pause for a bear market, and the tokenized RWA market, which has grown over 400% since the start of last year to more than $30 billion, isn't driven by retail narratives, even at all. It's driven by institutions looking for yield, efficiency, and real-time collateral mobility. So you get this split where the headlines say crypto is struggling and the backend infrastructure is quietly getting more embedded in how real money moves. Both things are true at the same time. What's really happening is that TradFi is adopting DeFi primitives without fully labeling them that way. Atomic settlement, programmable collateral, on-chain liquidity, These are the things that DeFi protocols have been doing for years. Institutions are now replacing them, but inside compliance frameworks and with their own capital behind them. And of course, DeFi itself is maturing to meet them. Permission pools, compliance structures, institutional grade liquidity layers. The Wild West phase is fading, which is good for crypto. Don't forget that. The ideological purity of permissionless finance is getting quietly negotiated with the reality that the biggest pools of capital in the world operate inside regulated structures. And that's not a defeat for DeFi, it's just how adoption works. And DeFi kinda has to adapt. TradFi brings the capital and the compliance, and DeFi brings the composability and the speed. The result here is a hybrid financial system that neither side originally planned for. Programmable, global, running around the clock, with proper regulatory structures where it needs to be. So to summarize, while everyone is watching charts and waiting for a catalyst, the more interesting question is, when does the market figure out that the war it thought was happening already ended and both sides start building the same thing? Because when that clicks, and I think it will, the repricing won't be gradual. The fundamentals are winning, I think the price just hasn't caught up yet. Let me know what you think, let's have a conversation in the comments below. Thank you so much for watching, I'll see you in the next video, cheers, bye bye.